Hi everyone, and welcome to part 3 of this 3-part video about the top 5 savings accounts in Canada that I think everybody should know about. In this video, we're going to cover the FHSA and the RESP. So the FHSA, or your first home savings account, is an investment account designed to help you save for your first home. You have to be at least 18 years old and a resident of Canada to open this account. This also has to be your first home, and you have to produce a written agreement on at least October 1st of the year when you plan to take out the money that proves that you're either building a home or that you intend to buy a home. You have to live in this home for at least 1 year, so it can't be an investment property immediately. And also you and your spouse, if they also have an FHSA, can both use your FHSA to purchase this home. Unlike the RESP and the TFSA or even the HISA, which you can use for whatever you want, you can't use this money for anything other than home-related purchases. So this can be either for a down payment, perhaps renovations or buying furniture. But if you happen to use that money for something other than home-related purchases, it'll be considered as taxable income and it will just be regularly taxed. The FHSA is a tax-sheltered account that combines the benefits of an RESP and the TFSA. Like the RESP, any contributions that you make to your FHSA are deducted from your income. However, like the TFSA, all of that money in the account grows tax-free and you don't have to pay any taxes on it when you withdraw it. This is really a huge incentive for buying a house. You can contribute up to $8,000 annually for a lifetime limit of $40,000. Any unused contribution room carries over to the next year, and the account can stay open for up to either 15 years or until you turn age 71, whichever one happens first. After that, all the money gets moved into either an RRSP or an RRIF. And if both of those accounts get maxed out, anything that's left will just be considered taxable income, it'll be taxed, and then you can do whatever you want with it. Over contributions to an FHSA are also subject to a 1% per month penalty, just like the RRSP and the TFSA. My personal strategy is to max out the account every year to give that money as long of a time horizon to grow until I'm ready to buy a property in Canada. The final account that we're going to talk about today is the RESP, or the Registered Education Savings Plan. This account is typically opened by a parent or a guardian to save up for one or more child's post-secondary education, though you can also open it up for yourself if you want to start saving towards your post-secondary education. Some key points about the RESP is that this is a tax-sheltered account. So it means that you put in after-tax income, however, it all grows without tax. The government also gives you grants for contributing to this account, so it's basically free money from the government. So with the RESP, there are 2 different types of accounts. There's a third account called a group account, but I'm not going to talk about that today. For the purpose of this video, let's talk about the individual RESP as well as the family RESP. In the case of the individual account, there is no age limit for the beneficiary, and they don't have to be related by blood to the person who opened the account. There's a $50,000 lifetime limit for how much you can contribute into the account. If you want to, you could put the $50,000 in right away, or you could spread it out between multiple years. The government will also give you up to $7,200 in government grants for the child, and low-income families are also eligible to receive more funding. In the case of the family plan, all the beneficiaries have to be under 21 years old. They also all have to be related by blood to the person who opened the account. The limits are exactly the same as with the individual plan, except this applies per child. And the cool thing about the family plan is that the money doesn't have to be used evenly between all the children. If one child decides to pursue a degree that's significantly more expensive than whatever the other child decides to pursue, then that child who chose the more expensive degree can use more money. The only thing is that the government grants are limited to only $7,200 per child. Let's now talk about the available government funding. The first type of funding that's available is the Canada Education Savings Grant. The Canada Education Savings Grant is available for absolutely everyone who has an RESP, and the way that it works is that the government will contribute up to 20% of your annual contribution to a limit of $500 per year. There's a lifetime limit that you can receive from the government, which is $7,200 in total, but you're eligible for that whole $7,200. So even if you didn't receive the full $500 for 1 year, that will roll over to all the other years so that you can get that maximum amount of $7,200. Again, low-income families could qualify for potentially more funding. The second type of funding that's available is called the Canada Learning Bond. You're automatically assessed based on your family income if you qualify for this bond. So this is designed for lower income families. But essentially for the first year that the RESP is open, every child will get $500. And then thereafter, they'll be eligible to receive $100 every year, up to a lifetime maximum of $2,000 extra dollars. There are 3 options for withdrawals when it comes to withdrawing from the RESP. The first option is called the PSC, the Post-Secondary Education Withdrawal. And this is a withdrawal made by the subscriber or the person who opened that account. They are eligible to take out any money that they contributed to the account, which was after-tax income, at any time, and it will not be taxed because they've already paid taxes on it before they even put it into the account. The second type of withdrawal is called the EAP, or the Education Assistance Payment. And this is a withdrawal that's made by the beneficiary themselves upon enrollment into their post-secondary education program. In this case, the beneficiary has access not to the original contributions made by the subscriber, but rather to the growth that came out of those contributions, as well as any government grants. So when the beneficiary withdraws this, because that growth was tax-free and the government gave you that money, that will be taxable income in the beneficiary's tax bracket. But because a lot of people after high school have either no income or very little income, they tend to fall into the lowest tax bracket, and therefore this money tends to be subject to very little tax or sometimes even no tax at all. And then finally, there's the option that perhaps your child chooses to not go to post-secondary, or maybe one of your children decides not to go to post-secondary. In this case, any of the government's contributions made into the RESP of that child can be transferred over to a sibling if they don't exceed the $7,200 maximum, or you can just give that money back to the government because you're not using it for post-secondary education. Regarding any investment income earned on your original contribution, you can actually transfer up to $50,000 from an RESP into an RRSP or your spouse's RRSP, or sometimes an RRIF if you're at that point in your life. However, if those accounts are maxed out, you can withdraw that money or withdraw whatever didn't fit into your RRSP or RRIF, and it will be taxed under the subscriber's tax bracket. So you as the subscriber, since you're making a lot more than the beneficiary, it will be subject to a hefty tax. And you will also face a 20% penalty because that money wasn't put towards post-secondary education as intended. RESPs can be open for up to 35 years, and you can contribute to an RESP up to 31 years. 35 years gives your child plenty of time to decide if they want to pursue post-secondary education or not, to avoid this scenario of paying these hefty penalties. As I mentioned, the $50,000 contribution limit is a lifetime limit, so there's no limit as to how much you can contribute per month. But if you go over $50,000 lifetime, any excess contributions will be subject to a 1% penalty per month until that error is corrected or that money is withdrawn. So to summarize the RESP, it's a powerful vehicle for saving for your child's future post-secondary education. There's a lifetime limit that you as the subscriber can contribute up to $50,000. The government will give you up to $7,200 per child to incentivize you to save. And when it's time to withdraw, there's several withdrawal options, even in case your child decides not to go to post-secondary. That brings us to the end of the final part of this 3-part video. Thank you so much for watching. I hope that this was helpful. If you found any of these 3 videos helpful, consider subscribing, drop a like, drop a comment, and I will see you in my next video. Thanks. Bye.